In every era of finance, there are a few rare individuals who don't just follow the markets, they decode them. They see the cracks before anyone else even notices the wall. And when those people step away from the game, it's never random. It's a signal. A quiet message to anyone paying attention that something underneath the surface has shifted. Today's story is about one of those voices. A man whose warnings once reshaped the global financial system, and who has just walked off the stage again. The investor who earned billions by calling the 2008 meltdown has officially shut the doors of his hedge fund. On November 10, 2025, Michael Burry's Scion Asset Management withdrew its SEC registration, a move far deeper than a routine fund closure. This is the man who dissected the subprime mortgage fraud while Wall Street cheered it on, the man who pocketed over $100 million as the financial world burned, and he is choosing to exit the arena entirely. Here's the part that should make every investor stop and think. In a letter dated October 27, Burry told clients that his idea of value hasn't aligned with market pricing for quite some time. Coming from anyone else, that's a complaint. Coming from the man who predicted the biggest financial crisis of our generation, that's a statement that the math no longer adds up. But what came next is even more remarkable. His final 13F filing for Q3 2025 shows nearly $912 million in put options against Palantir and $186 million in puts against Nvidia, massive wagers against two of the brightest stars in the AI universe. And these positions stretch deep into 2026 and 2027. This isn't a quick hedge. It's a long-term belief that a severe correction is baked into the system. Burry didn't stop there. He publicly accused major tech companies of manipulating depreciation schedules on their AI infrastructure, essentially claiming they were artificially inflating profits. That's not a casual market take. That's a charge of widespread accounting distortion across the sector. When a man with Burry's record makes an accusation like that, it's irresponsible to shrug it off. And then came the real curveball. Burry is converting Scion into a family office. No more reporting requirements, no more quarterly filings. After November, his portfolio goes completely dark. He's disappearing from public view at the exact moment markets are hitting fresh highs. Before going silent on Twitter, he left one final message. On to much better things. November 25th. This is only the second time in his career he's closed a fund voluntarily while markets were still pushing upward. The last time was in 2008, just before the entire financial system cracked. Back then, his bet against the subprime bubble returned 489% in 2007. He personally made 9 figures, then shut his fund down right as housing prices touched their peak. Now imagine the irony. The S&P 500 is near record highs. AI stocks look unstoppable. Retail investors can't buy fast enough. And the man who called the last major collapse is saying the market has become uninvestable, not because he's lost his edge, but because the numbers themselves no longer reflect reality. This isn't a man quitting. It's a master strategist stepping away from a board he no longer trusts. When someone who built his fortune by exposing financial illusions tells you that prices and truth have completely diverged, that's not commentary, that's a warning. And every investor in America should be asking the same question. If Michael Burry can't find opportunity in this market, what does that say about the storm ahead? Most people don't realize this, but legendary fund managers shutting down during market peaks is one of the most reliable crash indicators in US financial history. Every time a market genius has walked away saying the math no longer works, a major collapse has followed, usually within 18 months. Take Jesse Livermore, the original titan of speculation. In 1929 he was the most brilliant trader of his age, the man who cleared $3 million shorting the panic of 1907, back when $3 million could buy half of Manhattan. By late 1929, while America celebrated the roaring economy, Livermore quietly liquidated his long positions and began betting against the market. His peers thought he'd lost his grip. The Dow had tripled in 5 years. Everyone was getting rich. But Livermore insisted the market was no longer real, that stock prices had broken free from their earnings entirely. Then came October 24th, the crash. By 1932, the market had collapsed 89%. Livermore walked away with profit of $100 million, roughly $1.5 billion today, while millions lost everything. Jump ahead to March 2000 and the pattern repeats. Julian Robertson, the legendary manager of Tiger Management, had posted 31% annual returns for 2 decades, a streak Wall Street still admires. His fund held $6 billion and institutional investors begged for space. Yet in March 2000, Robertson stunned the world by shutting the fund down. His investor letter cut through the noise. The tech, internet, and telecom frenzy had abandoned any connection to rational investing. The media mocked him. CNBC said he was stuck in the past. Tech CEOs dismissed him as irrelevant. Investors fled value funds and poured money into dot-com dreams with zero revenue. 1 month later, the Nasdaq peaked. By 2002, it had collapsed 78%, erasing $5 trillion in wealth. Pets.com, once hailed as the future, was gone. The new economy turned out to be nothing but hype and momentum. Robertson was right. He was just 1 month early. And in markets driven by emotion instead of fundamentals, being early looks exactly like being wrong, until the crash proves otherwise. Now let's rewind to Michael Burry's first real battle with the market. Between 2005 and 2006, while home prices went vertical and banks tossed out no-income, no-job loans like parade confetti, Burry quietly began buying credit default swaps tied to subprime mortgage bonds. His own investors revolted. They accused him of losing touch with reality. Some demanded their money back. The financial elite treated him like an outcast. Bank CEOs dismissed him as unstable. Real estate brokers insisted housing prices never fall. Government officials claimed subprime lending was simply expanding the American dream. His own clients even took legal action to claw their capital out. But Burry had done what almost nobody else bothered to do: read the loan documents, analyzed the borrowers, and run the numbers. And the numbers told him something horrifying: the U.S. housing market was balancing on a mountain of fraudulent lending. In 2007, when the truth finally surfaced, his fund posted a staggering 489% return. He personally walked away with more than $100 million. And then, just as banks continued insisting everything was contained, he shut down Scion Asset Management. 6 months later, Lehman Brothers collapsed and the global financial system nearly followed it into the abyss. The man they all called reckless was the only one who had understood what was coming. This pattern goes far beyond Burry. It shows up across every era of American finance. David Einhorn of Greenlight Capital, who made billions shorting Lehman before it failed, spent 2020 and 2021 sounding the alarm about meme stock mania and markets distorted by the Federal Reserve. While GameStop and AMC rocketed to absurd levels on Reddit hype, Einhorn insisted fundamentals had been abandoned completely. Then there's Seth Klarman, manager of the $30 billion Baupost Group and one of the most disciplined investors alive. In 2020, he actually returned capital to his clients, something unheard of for a fund his size. His explanation: the market environment was the most distorted he'd seen in 40 years. The market kept rising anyway. But the underlying fragility he pointed to never went away. So what's the mechanism driving all this? When world-class value investors can't find opportunities, it means asset prices have snapped away from underlying economic reality. Markets run on two forces: fundamentals and momentum. And once momentum takes full control, even the smartest analysis becomes useless, so the smartest players leave the table. Every financial collapse starts with the same script. Prices soar beyond anything justified by earnings. Smart money starts taking profits. Dumb money keeps buying the top. The gap widens until even small pockets of selling trigger forced liquidations, margin calls, algorithmic exits, chain reaction panic. Retail investors never see it coming. They buy at the peak and sell at the worst possible moment. When Livermore warned about 1929, people laughed him off and then lost everything. When Robertson warned about 2000, day traders mocked his caution and were destroyed. When Burry warned about 2008, homeowners accused him of being un-American and then lost their houses. And now, the cycle is repeating almost word for word. Michael Burry is closing his fund for only the second time, using language eerily similar to what he used before the subprime collapse. The only difference is the bubble he sees now. In 2007 it was housing. In 2025, it's artificial intelligence. But the engine behind the bubble? Exactly the same. Cheap money from the Federal Reserve. Artificial demand. Prices that rise faster than reality. And the best investors quietly stepping back because they can't justify the math. What happens next has played out before, and it's never gentle for the people who ignored the warnings. So why is Burry convinced 2025 mirrors 2007 so closely? Look at his positions. His $912 million put bet against Palantir isn't a hedge. It's a statement. Palantir trades at more than 300 times earnings, when historic norms for the market sit around 15 to 20. Burry sees that as the same kind of mathematical impossibility he detected in subprime mortgages nearly 20 years ago. Think about that ratio, paying $300 for every $1 of profit. At that pace, it would take 3 centuries to earn back your investment from profits alone. That's not investing, that's blind speculation wrapped in futuristic marketing. And Palantir is only the opening shot. Burry's $186 million bet against Nvidia extends into 2027, which tells you he believes the AI chip revolution is built on accounting illusions and oceans of cheap capital, the same toxic fuel that inflated the housing bubble. Nvidia is now a $3 trillion company, larger than the entire stock market of the United Kingdom. And here's where Burry's accusation hits hard. He says major tech companies are manipulating depreciation schedules on their AI server hardware to inflate their profit numbers. In plain English, they're taking billions in hardware costs and spreading them over unrealistic time periods to make quarterly earnings look healthier than they really are. If he's right, the earnings holding up these sky-high stock prices are essentially an illusion, just like mortgage-backed securities in 2007 looked safe only because no one examined the loans inside them. The parallels across history are impossible to ignore. In 2000, companies with zero revenue were valued in the billions because the internet was changing everything. In 2007, home prices doubled in 5 years because real estate only goes up. In 2025, AI companies hemorrhage cash while their stock prices explode because artificial intelligence is the future. The storyline changes, but the math doesn't. And the math right now is flashing bright red. Consider the market conditions that fed this bubble. Just like in the mid-2000s, the Federal Reserve unleashed an ocean of cheap credit. When borrowing costs nothing, investors chase returns blindly. The result? The Magnificent Seven: Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, now combined for more than $15 trillion in market value. That's more than the economies of China or the entire European Union. 7 companies supposedly worth more than the productivity of billions of people. Ask yourself if that sounds sustainable. Here's how bubbles burst and who wins. Insiders always leave first. Executives dump their stock while retail investors keep buying. Venture firms cash out while pension funds double down. By the time the average American figures out something is wrong, the smartest money is already hiding in cash, gold, treasuries, and yes, put options on overpriced tech. Those will be the winners again. The losers? Retail traders holding AI stocks at all-time highs. Pension funds overloaded with tech exposure. And every investor who convinced themselves, this time is different. But here's the most unsettling part. Unlike past bubbles, this AI mania has infected the entire market. Your retirement account, your pension plan, your child's college savings, they're all exposed. Fund managers are forced to chase performance as the bubble inflates. In 2008, Burry earned $100 million because he recognized an impossible situation before anyone else, and he acted. He is saying the same thing again. In 1929, Livermore warned prices were artificial. Ignored. In 2000, Robertson warned valuations had severed from reality. Ignored. In 2008, Burry warned the entire mortgage system was rotten. Ignored. And now, in 2025, he's walking away again, saying markets can no longer be navigated using reason. History doesn't repeat perfectly, but it rhymes with shocking precision. The cycle is always the same. Brilliant investors spot the impossibility, sound the alarm, get mocked, then get vindicated when reality finally snaps back. The man who called 2008 is calling 2025. The only question is whether you'll listen this time or learn the lesson the hard way, alongside the millions who never do.